I do want to bring in our markets guest here, Louis Navier. And Louis comes from Navier and Associates. He is the founder and chief investment officer. So thank you for joining us here today. You've been listening to our markets discussion. I'm just wondering what your overall impression is. This is typically a low volume period of time, but people are thinking ahead to the new year. Just wondering what's grabbing your attention today.
Well, we're melting up. The small caps had a very, very serious correction. It started the Friday after Thanksgiving. They bottomed on December 3rd. They retested those lows a week ago today, and they were rallying last week, but now they're rallying again on very light volume. So we're going to have a very strong January effect in January, because if we can rally on light volume, we're going to get an explosion to the upside when the volume increases in January.
And I wanted to ask you, Louis, what do you make of the bond market? It just isn't moving. So what does that bode for stocks going into 2022?
Well, I think the big news in the bond market is twofold. One is before the Fed meeting, we had very successful Treasury auctions with great bid to cover ratios, and 69% of the buying of the 10-year was international. And you can see today we have a very strong dollar. We have a very soft Europe. They're taking Omicron a little bit more seriously and slowing their economy down. And all this international money just pours in to shove our Treasury yields lower. And we saw after the FOMC statement and Jerome Powell's press conference, yields drop. So people have to realize that they're never going to raise rates significantly. We have a $30 trillion deficit. The interest is already more than the Defense Department. They can't raise rates. Our government's doing something called modern monetary theory, which is what Europe pioneered, unlimited money printing. So in this inflationary environment they're creating, we just have to buy stocks. I mean, that's the oasis.
And you mentioned the dollar a minute ago. I want to call up the Wi-Fi Interactive here, where we're looking at a 3-month chart of the Dixie. That's the U.S. dollar index, heavily trade weighted toward the euro, admittedly. But we did see this big rise in November. We got to some technical levels, and we just kind of petered out and gone sideways for a month. Given your thesis with respect to the Fed that they can't raise rates that much, what does that say about your expectations for the U.S. dollar?
Well, the dollar is going to be strong for 3 reasons. One, it's liquid. Second, we have a stronger economy than the rest of the world. And third, we're a more entrepreneurial country than other countries. Really what makes America great is we have 50 states trying to compete with each other. And no matter who we elect, we're going to grow and prosper regardless. So we just have a better model than other countries. You know, Scotland isn't rating Wales for business, you know. So we just have a better model, and we're the envy of the world. And we also do have orderly immigration. I know that's a sore subject, but we have a lot of, legal immigration for the talented people that come here. So it's just a place to be successful. And so the dollar is going to be strong for a long time.
And so then, in your opinion, you sound quite bullish on the next year. What sectors are you looking at to invest in?
I'm loaded in semis. I have more than I can name, but I mean, obviously, I have Navellier, United Microelectronics I really like. On the consumer end, we love Crocs at this moment. It dropped last week after an Italian acquisition, but it's a great buy now. Dillard's, Kohl's has also showed up. And we like special situation monopolistic companies that dominate their business, but the semis are phenomenal. I also have tons of shipping companies, obviously profiting from the port bottlenecks. I have logistic companies like Expeditors, helping to get things around. Trucking companies like TFI International, that's a Quebec company, but they truck all over North America. So there's a lot of we have a lot of good companies to invest in. The year-over-year comparisons are going to get a little more difficult as we go in the new year, and you're going to find the few stocks that can sustain earnings momentum with a margin expansion are going to be the oasis. I do expect the market to get more narrow as 2022 continues.
So would it be fair to say then it's maybe becoming more of a stock pickers market? I'm just wondering, when you hear the debate of active versus passive, how do you see the market evolving over the next year? Is it going to be rewarding investors who just put their money in an S&P 500 fund, or do they have to get a little bit more creative here?
Well, first of all, I started in indexing. I'm from Berkeley, California, and I was taught that we're all supposed to index because we would create social unrest if we tried to out earn each other. And so I used to build tracking portfolios, and I was a failure because I kept finding stocks that were beating the market. So I don't believe that. I don't believe in indexing. But the truth of the matter is indexing is powering these FANG stocks. It's now powering Nvidia. It's supporting Tesla. So once you get added to these big indices, it will support you. I was shocked that NASDAQ added Lucid, okay, because when a company goes public, you know the VCs are going to cash out. You know the insiders are going to cash out. And then, of course, they had the little SEC investigation in the SPAC. So, I mean, I'm not saying Lucid shouldn't be in the NASDAQ 100, but it got added too early, okay? And obviously, everybody loves the car. In fact, I'll be in Arizona tomorrow where they make it. And but it's just it's going to be a stock picking market, and you can already see that Google and Nvidia are better than some of the other the FANG components right now. So I'm a stock picker, and I always have been, and that's what I enjoy.
Now, Louis, not much more time to go, but want to get your assessment. Exactly 1 year ago, from where you were sitting, did you think the S&P would be hitting 4,700 today at the end of the year? And then where do you see it going next year?
I actually thought it would go up a little bit more. We've had a lot of PE compression. The market is not going up as much as earnings, and that's normal. You know, I'm a growth guy, so if I have a stock that has 60% earnings growth, I expect it to maybe go up 30% due to the PE compression. But I think the fear of higher rates has held that back. But when investors increasingly realize that we're never going to have really high rates, then I think you'll see a bigger explosion in stocks. So I'm not sure when that realization is going to occur, but the high multiples are going to be here for a long, long time because interest rates are so low. And stocks are the best inflation hedge. By the way, the strong dollar is creating windfall profits for the S&P. Half the sales are outside of America.
All right. We will have to leave it there. Louis Navellier and Associates founder and chief investment officer. Thank you so much for your time and insight today, and wishing you a very happy new year.